And look, $8 trillion just bailed on America's banks. But there aren't any lines at any banks right now. No panicked depositors clutching their life savings in canvas bags. No emergency weekend meetings at the FDIC where regulators nervously loosen their ties and contemplate career changes. Everything pretty much looks fine. Except it absolutely isn't fine. Not even a little bit. Because I think we've been lied to about what a bank run actually looks like today. Because one is happening right now as you sit there watching this. And it is the biggest one in years. And the quietest one you've ever seen. There's no panic. And that is exactly why nobody is calling it what it is. It's slow, it's silent, and it's pulling money out of accounts that look exactly like yours. This isn't a warning about something that's coming. It already started. By the end of this, you're going to understand a quiet financial migration that has already moved nearly $8 trillion out of the traditional banking system. That's the kind of number that should come with its own theme music and a warning label. And yet, somehow, the credit engine that funds Main Street America is currently running on fumes without a single headline to show for it, which is insane. Because we write headlines about everything. We wrote headlines when someone found a Cheeto shaped like the Virgin Mary. But $8 trillion quietly evacuating the banking system? Crickets. Let me start with this number. The average American savings account at a regional or community bank is currently paying you 0.61% per year. That is the national average right now, according to bankrate.com, 0.61. Now hold that next to this one. The yield on a 4-week United States Treasury bill is about 3.6%. That is nearly 6 times what you're earning at your local bank for exactly the same risk. Essentially, zero risk. Because the US government backs that Treasury bill just like the FDIC backs your savings account. Same safety net, 6 times the return. It's like choosing between a sandwich and 6 sandwiches when both are free and neither will give you food poisoning. And look, you don't have to take my word for where that 6th sandwich is hiding. The bank's actually paying you 4% and up right now, today. I put the whole list down in the description for you. That right there is the move. And we'll circle back to it. But if you do nothing else after this video, look at that and take action. And here's what American depositors have done in response to that math. They have voted with their wallets. And their vote was, screw this, I'm out. Money market funds, which are basically parking lots for cash that people pull out of banks, now hold $7.9 trillion in assets. That is an all-time record, and they've been quietly setting fresh ones week after week after week. To put that into perspective, the entire Federal Reserve balance sheet at its quantitative easing peak was about $9 trillion. We have essentially built a shadow treasury system almost as large as the Fed itself. And the financial press? Not talking about it, because nobody panicked. No depositor made a scene. The money just left. And when the press does mention it, they call it an orderly asset reallocation. 3 soft, bloodless words engineered to make a massive structural flight from a rotting foundation sound like someone just rearranged the patio furniture. Let me tell you where that money came from and why it matters to your wallet, even if you haven't personally moved a single dollar. The top 25 largest banks in America, your JP Morgans, your Bank of Americas, your Wells Fargos, they have something the regional and community banks simply do not: scale. Wholesale funding markets. Institutional depositors who don't move their money for an extra 50 basis points because they're too busy being institutional depositors. When deposits leave the big banks, they have ways to replace them. They tap funding markets. They issue bonds. They call their friends at other big banks and work something out over a lunch that costs more than your typical car payment. The other 4,000 plus banks in this country, everyone outside that top 25, they can't quite do that. The Federal Reserve calls these small, domestically chartered commercial banks, which is bureaucrat speak for the banks that actually serve your town. These banks hold roughly $5.5 trillion in deposits, and that base is being drained month by month by depositors who did the simple math and realized they can earn 6 times more from the government than from their local branch. And so, deposits quietly leave. This is what's happening at kitchen tables across the country. People Google best savings rate at 11 p.m. on a Tuesday because they can't sleep and they're worried about their money. Understandably. They see T-bills pay 3.6%. They see high-yield savings accounts paying 4%. Their bank pays 0.61%. So they move their money in 5 clicks, maybe 6 if they have to reset their password. Multiply that by tens of millions of households, and you have what I'm calling the shadow run. Slow, rational, silent, and structurally devastating to the regional banking system's ability to lend. Here's the data most analysts aren't focused on. Community and regional banks aren't just where you cash checks and run into your old high school English teacher. They are the primary lenders to small businesses, to farmers, to the developers building things in your city. More than 1,800 banks in America are carrying commercial real estate exposure above 300% of their capital base. And most of them are exactly these small regional lenders. 300%. That means if their capital is $1, they've lent out $3 against commercial real estate, which is fine. Totally fine. It's fine the exact same way it's fine to juggle lit dynamite while riding a unicycle across a tightrope made of dental floss. It works beautifully right up until the precise microsecond it catastrophically does not. These banks are already stretched. They don't have room to lose deposits and keep lending. You see, banking, it's really simple. Here's how it works. Deposits come in, loans go out. The spread between the two is how banks make money. It's basically a very boring sandwich shop, except instead of bread and turkey, it's your money and someone else's mortgage. It works, right up until the bread stops showing up. When deposits leave, loans follow. Not immediately, not with a press release, but it follows, like clockwork, like a tide going out. Except the tide is credit, and when it goes out, the small businesses floating on it are left high and dry. Now here's where it gets properly insane. The Fed is now openly eyeing a rate hike, and there's a new sheriff in the building. The Fed is now run by a guy named Kevin Warsh, and at his very first meeting, back in June, he reached into the Fed's official statement, tore out the part that hinted at cutting rates, and replaced it with a flat-out promise to crush inflation. So why the sudden tough guy act? Well, one word, oil. The war with Iran sent gas and energy prices through the roof, and that shoved the Fed's favorite inflation gauge, the PCE, up to 4.1% a year. That's the hottest reading since April of 2023, and it landed just last week. Now everyone's asking the same thing. What does a rate hike actually do? Well, it widens the yield gap between what Treasury bills pay and what your local bank pays. A wider gap means more deposits leave regional banks. More deposits leaving means tighter credit. Tighter credit means slower growth, through a mechanism the Fed doesn't seem to be fully considering right now. The Fed held rates at 3.5 to 3.75% at the June meeting. That's the 4th hold in a row. But the latest dot plot, which sounds like a children's game, but is actually a chart of where Fed officials think rates are headed, now points to a hike by year's end. Not a cut, a hike. One rate hike in an environment where the average savings account already pays a fraction of what T-bills pay. If that hike comes, the shadow run doesn't slow down, it accelerates. The gap gets wider. More people do the math, more money leaves. The banks have less money to loan, and so credit contracts. Here's what a credit contraction actually looks like in real life, though, and why it never makes the evening news until it's too late. The small business owner who can't get a line of credit in Q3 doesn't show up as a headline. They show up in Q4 when they have to let 2 people go. And the farm bank in Iowa quietly raising its collateral requirements because its deposit base shrank, that farmer feels it in the spring, when the planting loan doesn't come through on last year's terms, and then food gets more expensive, and we write articles about inflation without ever connecting it back to depositors who moved their money to T-bills 9 months earlier, meaning what they're doing today, right now. Today is 9 months earlier. This is the transmission mechanism the Fed isn't adequately considering. They watch the CPI, they watch the PCE, which just printed hot last week. They watch non-farm payrolls. They watch job numbers that get revised 3 months later after everyone has stopped looking. What they're not pricing in is a structural deposit migration quietly draining the credit capacity of the 4,000 plus banks that fund Main Street USA. And transmission mechanism is just the technical euphemism for the pipe that carries the toxic sludge from their world straight onto your front lawn. They reach for words like models and mechanisms because the plain version, the money flows out of your town and does not flow back, sounds exactly as bad as it actually is. By the time the headline numbers catch up, and they will, because math is patient but unforgiving, the credit contraction will already be here. The damage will be done. And we'll all stand around asking, how did this happen? While pointing at a chart that showed us exactly how, the whole time. So what does this mean for your money? Well, 3 things. First, if you're keeping real cash in a savings account earning less than 1%, you are handing your bank free money. I mean, handing it over. Let's do the math out loud. Put $50,000 in the average account at 0.61%, and after a year, you've earned about $305. Put that same $50,000 in T-bills at 3.6%, and you've earned about $1,800. That's roughly $1,500 a year, about $4 a day, that you're donating to your bank for nothing, for the exact same safety net. And here's the part everybody gets backwards. A Fed hike doesn't fix that. It makes it worse. You see, when the Fed hikes rates, your bank passes almost none of it on to you. They kept you at 0.61% through the last round of moves, and they'll do it again. But T-bills and the real high-yield accounts reprice upward fast. So the gap doesn't close, it widens. The best high-yield savings accounts are already paying up to 4.15% right now. Waiting for your bank to catch up is waiting for a bus that is never coming. The 3 banks I personally use to capture that 4% are posted at stackmybanks.com. I put a full list of the top 10 for you down below in the description. Now the second move, if you own regional bank stocks, this is a deposit-based problem, not just a profit margin one. A bank that can't hold its deposits can't grow its loan book. And the ones already stretched thin on commercial real estate while their funding walks out the door are carrying a risk a lot of analysts are still underrating. Translation, some of those stocks are priced for a sunny day that may not show up. Third, and this is the one to carry with you, the credit contraction that follows a shadow run, it's not announced. There'll be no press conference, no emergency Fed statement. It arrives as a slow tightening of credit that hits small businesses first, then commercial real estate, then hiring, and then the GDP. The headline numbers will catch up, they always do. The only question is whether you're positioned before they do or after. And after is a very expensive place to be. So here's the deal. The bank run that matters most right now is happening in total silence. It's not fear-mongering, it's math. Because when the government pays and high-yield savings accounts pay nearly 6 times what your local bank pays for exactly the same risk, national depositors do rational things. And thousands of community banks are slowly losing the war for your cash, one kitchen table decision at a time, made by people who just want their money to work as hard as they do. And that is how a financial system quietly breaks without a single headline to warn you it's happening. But here's the thing, a silent run this big doesn't stay a secret forever. Somebody always spots the gap before the headlines do. And the somebody who spotted this one isn't a hedge fund you've never heard of. It's the new richest man in the world. The gap between what your bank pays and what your money is actually worth got so wide that the wealthiest person alive looked at it and said, fine, I'll just build the bank myself. And I'll pay the people 10 times what the banks are paying now. And that's why I pulled this one out here for you to watch next, because Washington is already nervous about this. And there's an asterisk hiding on that FDIC sticker. I laid it all out for you right here, because the most expensive move you can make right now isn't picking the wrong account. It's leaving your money exactly where it is, bleeding $4 a day, and telling yourself the run isn't already happening. So watch this next. God loves you, and so do I. Take care.